Every crisis begins with optimism. In the 1970s, Latin America was rising, oil was booming, commodities were strong, international banks were overflowing with cash, and money was cheap, very cheap. American banks had dollars to lend, billions of them. After oil shocks flooded global markets with petrodollars, financial institutions needed a place to park capital, so they looked south. Mexico, Brazil, Argentina, Chile. Governments borrowed heavily in US dollars. The logic seemed sound. Growth would continue, exports would rise, debt would be manageable. But debt is stable only when conditions remain stable, and conditions changed. In 1979, the Federal Reserve, led by Paul Volcker, made a historic decision. To crush inflation in the United States, interest rates were pushed dramatically higher. Rates surged above 15%. For Americans, it meant recession. For Latin America, it meant catastrophe. Most of the region's debt was denominated in US dollars. When US interest rates rose, so did their borrowing costs. At the same time, the global economy slowed. Commodity prices fell, exports weakened, dollars became scarce. And then, in August 1982, Mexico made the announcement that changed everything. It could not meet its debt obligations. Mexico was effectively bankrupt. The shock rippled instantly through global finance. American banks were deeply exposed. If Mexico defaulted fully, major US institutions could collapse. The crisis was no longer regional, it was systemic. Soon, other nations followed: Brazil, Argentina, Venezuela. One by one, debt payments were suspended or restructured. The boom of the 1970s became the lost decade of the 1980s. Inflation spiraled out of control. In some countries, prices doubled in months. Currencies collapsed. Savings evaporated. Poverty surged. The International Monetary Fund stepped in. Bailouts were arranged, but assistance came with conditions. Structural adjustment programs demanded austerity. Government spending was cut, subsidies removed, state industries privatized. The goal was stabilization, but the social cost was severe. Economic contraction deepened, unemployment rose, political instability followed. The Latin American debt crisis revealed something fundamental about the global financial system. When debt is issued in a foreign currency, the borrower does not control its destiny. Latin America had borrowed in dollars, but it did not control the dollar. When US rates rose, their economies were crushed by forces beyond their borders. This was the power of the global reserve currency. The United States could tighten its policy to fight domestic inflation, but emerging markets absorbed the shock. Eventually, restructuring plans like the Brady Plan in the late 1980s helped stabilize the region. Debt was exchanged for new bonds. Confidence slowly returned. Growth resumed, but the scars remained. An entire generation lived through economic stagnation. Trust in institutions weakened, and policymakers around the world learned a lesson that echoes today. Debt can accelerate growth, but when rates rise, when liquidity disappears, when confidence breaks, debt becomes a chain. The Latin American debt crisis was not just a regional tragedy, it was a warning about leverage in the dollar-dominated world. Because in the age of debt, borrowing in someone else's currency means surrendering control. And when the tide of global liquidity retreats, it exposes who was swimming on credit. The crisis ended, but the structure remained. Emerging markets still borrow in dollars, the Federal Reserve still sets global financial conditions, and sovereign debt continues to expand. The story of the 1980s is not just history, it is a blueprint. Because when interest rates rise, somewhere in the world, a balance sheet begins to crack. This is the age of debt.